$5,000. A down payment on a car, a few months of rent, a round trip to Europe. But what if I told you, right now in March 2026, there are people quietly turning that exact amount into $10,000 in 12 months? Not luck, not gambling, not some crypto scheme. This is a strategy built on real data from Goldman Sachs, VanEck, Bernstein, and the biggest financial institutions on the planet. In this video, I am going to be direct. No fluff, no vague advice. If I had $5,000 right now, this is exactly where I would put every single dollar. Let's get into it. Before we talk about where to put your money, let's understand where the market actually stands right now. But what if I told you, right now in March 2026, there are people quietly turning that exact amount into $10,000 in 12 months? And now in early 2026, a lot of people are scared. They think the crash is coming. They are sitting on cash, waiting. But here's what the data actually shows. The S&P 500 is currently trading about 6% below its fair value, according to analysis from Forecaster Terminal. That means the market still has room to run. Now, 2026 is a midterm year, the middle of a presidential term. History shows these years tend to be more volatile. Markets can drop 10, 15, even 20% before recovering. So, who wins in a year like this? Not the people who guess, not the people who panic sell. The winners are those who know exactly what they own and why. And that is exactly what we are about to build together. First, investment. And the one with the highest upside potential, AI stocks, specifically NVIDIA, Broadcom, and Microsoft. Let's look at the numbers. NVIDIA, the company with the largest market cap on Earth, just reported annual revenue of nearly $216 billion for fiscal year 2026. Wall Street is projecting 52% revenue growth in the next fiscal year. That is not a typo. 52%. Broadcom, less well-known, but quietly becoming one of the most important AI infrastructure companies in the world. Their AI chip revenue is expected to double year over year in Q1 2026. They are going directly after NVIDIA's market with custom AI chips. Microsoft, Azure Cloud grew 39% compared to the same period last year. And right now, the stock is trading at one of the lowest PE ratios in years. That is a rare buying opportunity. With $5,000, I would put $2,000. That is 40% into this AI group. Split it evenly. NVIDIA, Broadcom, Microsoft. Is there risk? Yes. This is the most aggressive part of the portfolio, but AI is the fastest growing sector on the planet right now. And if that trend continues, doubling in 12 months is not a fantasy. Second investment, and the one most people are sleeping on, gold. Let's look at the real numbers. In 2025, gold gained 60%, the biggest single-year increase since 1979. As of March 2026, gold has already climbed another 12% this year. It is currently trading around $4,840 an ounce. Goldman Sachs is targeting $4,900 by year-end 2026. Bank of America is calling $5,000. VanEck, one of the world's largest investment funds, agrees. Why is gold so strong right now? 3 reasons. 1. Central banks around the world are buying gold at a record pace. 3 consecutive years of record central bank purchases. 2. The U.S. dollar is weakening. It is down nearly 10% against major currencies. When the dollar falls, gold rises. That relationship is unbreakable. 3. Geopolitical tension and Trump's tariff policies are pushing investors toward safe haven assets, and gold is the most classic safe haven of all. The easiest way to invest: do not buy physical gold. Buy a gold ETF, GLD or IAU, directly from your brokerage account. Simple, highly liquid, no storage fees. With $5,000, I would put $1,250, 25%, into gold. This is your portfolio's shield. It protects everything else when markets swing. Third investment, only for people who can handle the shock: Bitcoin. Let me be honest with you about where Bitcoin stands in early 2026. In 2025, Bitcoin hit an all-time high of $126,000. Then it corrected hard. A lot of retail investors panicked and sold. But here is what is actually happening right now. Institutional money is moving in, while retail money is moving out. History shows this has always been the best time to accumulate. Standard Chartered is projecting Bitcoin hits $150,000 in 2026. Bernstein has a $200,000 target for 2027. VanEck's recommendation: buy gradually using dollar cost averaging. But here is the most important thing I will say in this entire video. Bitcoin is the most volatile asset on this list. It has dropped 60 to 70% in a matter of months, multiple times in history. Never invest money in Bitcoin that you cannot afford to lose entirely. The safest way to get exposure: the BlackRock Bitcoin ETF, ticker IBIT, over $67 billion in assets. No crypto wallet, no private keys to manage. Just buy it like any other stock. With $5,000. I would put a maximum of $500, just 10%, into Bitcoin. Enough to benefit if it runs, not enough to destroy you if it falls. Fourth investment, the least exciting on this list, and the most important, the S&P 500 ETF. The S&P 500 tracks the 500 largest companies in America: Apple, Microsoft, Amazon, Google, Nvidia, all in one. In 2025, it returned 17%. For 2026, analysts are projecting another 15%. Year-end target, 7,900 points. But here is the number that really matters. In 100 years of history, the S&P 500 has never failed to recover from a downturn. Every single crash, it came back higher, every single time. This is why Warren Buffett, the greatest investor alive, told 90% of individual investors to put their money here and nowhere else. Best ETF for this? VOO from Vanguard. Expense ratio, 0.03% per year. Basically free. With $5,000, I would put $1,250, 25%, into VOO. This is the foundation of your portfolio, the anchor that keeps everything stable when the rest gets volatile. Before we get to the final summary, I want to show you something most channels never talk about. What actually happens to your $5,000 if you do nothing with it? Option 1. You leave it in a regular savings account. The average U.S. savings account pays 0.5% interest per year. After 12 months, your $5,000 becomes $5,025. $25. That is it. Meanwhile, inflation in the U.S. is running around 3% per year. That means the real purchasing power of your $5,000 has actually decreased. You did not just make nothing, you lost ground. Option 2. A high-yield savings account. Best case right now, 4.5% APY. After 1 year, $5,225. Better, but still barely keeping up with inflation. Option 3, the portfolio we just built. Even at a conservative estimate, 15 to 20% average return. After 1 year, $5,750 to $6,000. Minimum. And if the AI stocks and Bitcoin run, potentially much, much more. The cost of doing nothing is not zero. Every year you wait, inflation quietly erodes the value of your money. The best hedge against inflation is not cash sitting in a bank. It is assets that grow faster than inflation, and that is exactly what this portfolio is designed to do. Before the final summary, I need to warn you about 3 mistakes that destroy most new investors. Mistake number 1, trying to time the market. Every week, I hear people say, "I will invest when the market dips," or "I will wait until things calm down." Here is the truth. Nobody, not even the best hedge fund managers on Wall Street, can consistently predict the perfect entry point. Studies show that missing just the 10 best trading days in a decade cuts your total returns by more than half. The solution is simple. Invest consistently every single month, regardless of what the headlines are saying. Mistake number 2. Panic selling during a downturn. In 2020, The S&P 500 dropped 34% in 5 weeks. Millions of investors sold everything, locking in their losses. 3 months later, the market had fully recovered. By year end, it was up 16% from where it started. The people who sold missed the entire recovery. The people who held came out way ahead. Mistake number 3, putting everything into one stock. This is the most dangerous mistake I see from new investors. They find one company they believe in and go all in. Even great companies can collapse overnight. Enron, Lehman Brothers, FTX. Diversification is not just a strategy. It is your survival mechanism. Never put more than 10 to 15% of your total portfolio into any single position. Avoid these 3 mistakes, and you are already ahead of 80% of retail investors out there. All right, let's bring it all together. If I had $5,000 in March 2026, here is exactly how I would divide it. 40%, $2,000, AI stocks, NVIDIA, Broadcom, Microsoft, the highest upside and the highest risk on this list. 25%, $1,250, gold via GLD or IAU. The top performing asset of 2026, Goldman and Bank of America are both calling $5,000 an ounce. It protects your portfolio when everything else gets choppy. 25%, $1,250, S&P 500 via VOO. The foundation, the anchor. 100 years of evidence says it goes up over time. That is good enough for me. 10%, $500, Bitcoin via IBIT. High risk, real upside, $150,000 target from Standard Chartered. Only put in what you can afford to lose. Now, let me be clear about something. This is not a get-rich-quick formula. There is no such thing in real financial markets. What this is a strategy built on real data from the most respected institutions in the world, designed for people who are serious about making their money work for them. The market will be volatile. There will be weeks where your portfolio is down. That is when 90% of new investors quit. And that is exactly when the other 10%, the ones who stay, win. If this video gave you a clearer picture of where the US market is heading, hit like. It helps this channel reach more people who need this information. Subscribe to Capital Lens. Every week we break down real opportunities happening right now in global financial markets. And leave me a comment. Out of these 4 investments, which one would you put money into first and why? I read every single comment. See you next week. And remember, the best time to start was yesterday. The second best time is right now.